All right, let's stick with technology here. Our next guest is still betting on some of last year's biggest winners, and he's also bullish on a turnaround in China this year. Let's welcome in Dan Niles, founder and portfolio manager of the Satori Fund. Dan, great to see you. Happy New Year.
Happy New Year, too.
Dan, I want to start off with the microchip news because in a past life, you were a renowned semiconductor analyst, and on your list of top picks for 24 is Texas Instruments. And so I'm wondering to what extent, if at any, you are concerned about this issue of double ordering and some of the weakness that chip makers might experience who feed into automotive and industrial.
No, I'm thrilled to see it because you have to remember I have longs and shorts. So if you look at Texas Instruments, they went into this downturn early. And what we've been saying for a long time is that each semiconductor company is going to see this at a different time, depending on how much double ordering they had, and their ability to meet demand. TI was able to meet demand early, so their revenues have gone down over 10% year over year for 4 quarters in a row. We actually think there's probably some upside to 2024. For a lot of these other companies, like a microchip, et cetera, we think there's downside. And so TI was up 3% last year. The semiconductor index was up 65%. So we have a lot of shorts in the semiconductor space to balance out the long that we have in TI, counting on the fact that things will normalize, and it isn't different this time.
Hey, Dan, so we were just talking about Nvidia, which had this bang-up year last year, obviously up over 200%, $1.3 trillion market cap, broke out today. So that was a consensus long last year. It came in as a consensus long in 2024. How are you thinking about consensus in tech? And to the point that Mel just made about some of these names that have disappointed, it's baby with the bathwater. We saw Mobileye shoot first, ask questions later last week. How are you thinking about how investors are positioned, and how do you think about consensus right here?
Well, I think last year it had nothing to do with earnings, right? Apple's Q4 December quarter EPS, which they're going to report in a couple of weeks, is down 10% from where they started last year. The stock's up 48%. Tesla, the EPS for December quarter is down 50%, and the stock was up 100% last year. Because of the run-ups into 2024 and our view that there's going to be a soft landing, the Fed's going to cut, and everything is just peachy, you're going to need these companies to start putting up numbers. And as you said, with Mobileye, the stock went down, I think, 25% the next day when they announced negatively. We'll see what happens with microchip tomorrow. But I think the rubber hits the road with this earnings season. And so for companies like Nvidia, where I think you're going to get 2 more quarters probably of massive beats and raises, and you're paying a 28 PE for the stock, we own it. We were fortunate in that we came into today very long, that name. And we still think that's a good place to be. You look at other names, for example, Nvidia's at 28 times, the market's at 20 times. You look at an Apple that's at 27 times, and you go, really, I'm going to pay 27 times for a 5% revenue growth this year. I think that 5% is going to go down, whereas Nvidia's number is going to go up. So I think the good news is this is going to be a stock picker's nirvana, I think, this next year, because you're not going to get stocks right just because you go, oh, it's Apple, it's big, the chart looks good, buy it. You're going to actually have to get the fundamentals right to make money.
We're showing on the screen, Dan, some of the names that you're long, Amazon, Meta, we know Texan, biotech, Chinese internet. That seems really interesting and quite contrarian at this point. What is the biggest risk in your view? What is your biggest fear about this trade? Because some of the stocks, the fundamentals seem okay, but, the environment and just the foreign investment perception of them is terrible.
Yeah, well, I'm glad you called it contrarian and not idiotic, so I'm pleased with that. But with regards to K-Web, you're right. It's the riskiest out of our picks. But I'm a big believer in that actions speak louder than words. And if you look at the China internet space, the Chinese government has been just viciously going after these companies ever since they blocked the Ant Financial IPO in November of 2020. And so if you look at their equivalent of FANG, which is BAT, which is Baidu, Alibaba, and Tencent, even though the government's been doing this, over the last 3 years, revenues have gone up 33%. The stocks, those 3 stocks, have gone down 53%. And the PE is now 13 times on average for those 3, compared to the Magnificent 7, where you've got it about 34 times or so. And so all you need is to go from just vicious persecution to just benign neglect. And it's going to get better. And why I think we've moved into potentially that category is the government started to step up and buy stocks and trying to support these companies because they're below the levels that they were at the bottom of COVID, at the bottom of 2022, but the revenues are still growing. And so much like you saw last year, had very little to do with earnings in some cases, where the multiples just went up a lot. If you can just get some minor view that the government is letting up on this, I think you're going to see the stocks able to re-rate a lot higher. So definitely the riskiest, but also the most upside from valuation if we just get to a different regulatory regime.